Yeah, there's been some interesting like developments, macro economy related. It seems like, inflation is coming in maybe a little bit hotter or stickier, and growth looks like it's coming in a little bit slower. I don't know what the GDP print was, like 1.6 versus 2 something, if I'm getting the numbers somewhat right in there. So I'm just, and I think the market is somewhat reacting to that, it seems like. And just, can you give us an overall view of where you think we are economically?
Yeah, I mean, I think from an overall economy perspective, we're still very late cycle. Unemployment rates at secular lows. Income growth as a function of that is still relatively elevated, which is leading to nominal spending that's too high relative to the productive capacity of the economy. And the combination of that means that inflation is still elevated above what the Fed's target is. I think I think the resilience of the economy has surprised many folks, given that we've basically have been at this higher rate environment, for 18 months or so, and there's nooks and crannies of the economy that are weaker, for sure. If you're a loss-making, debt-laden private equity-backed company, life's a little tough for you. But if you're a cash flowing business, if you're a big business, if you're a household that's got, decent income growth, you're employed, decent income growth, and a 3% mortgage, and your 401k zooming up and your house price going up, things are going pretty well. And so I think that all speaks to the sustainability of this current expansion being much more fueled by income growth than most of the expansions that we've seen in our careers, which are much more debt-oriented expansions. And income-driven expansions, they can last a long time. There's no unsustainable activity when you have an income-driven expansion the way that we're having.
Yeah, so that's a big part of the resiliency is this income levels have stayed up, employment has stayed relatively healthy in most areas. And so people have money coming in, consumers are spending money. Because, it is, if you think of it to your point, it's like how much rates moved, the cost of borrowing. You would have thought that would have had more, there would have been more pain in different areas. There's pockets of it, commercial real estate in certain areas, even though that's being, so yeah, it's interesting how resilient it's been.
Yeah, and I think in many ways this expansion, I think a lot of people find this expansion to be very confusing, and then they're sort of like fumbling around to find the explanatory
Mm-hmm.
dynamic that's going on. Oh, it must be fiscal, but the fiscal position of the U.S. is actually the deficit's actually been contracting for the last couple of years, or it must be interest that's funding everything, but that has added at most 50 basis points of GDP growth over the last few years. That people are fumbling around, they don't understand it, and that's because the cycle we're experiencing today is actually much more akin to the old time cycles of like the 50s and the 60s, where you have these sort of income based expansions and they're quite persistent. And it doesn't mean that monetary policy is totally ineffective. It has its effect to some extent. But when you have borrowing as soft as it already is, the borrowing channel is not going to be the big channel for creating the slowdown in the economy. Basically, what has to happen is interest rates have to rise enough to start to create a drag on asset prices, and that drag on asset prices will then create a desire to save more and spend less, and that'll create a slowing of spending, which will create a deterioration of earnings, which will create a deterioration in employment. But when we look at that cycle, like where are we? We squint at the S&P 500 every day, like we're not at peak, but heck, we're percentage points below peak. And we look at house prices, they just keep going up, right? For most people, hardly a flesh wound there in terms of the tightening that's gone on so far.
On Twitter, you outlined a framework where you articulated a way that inflation ultimately might get might get stomped out here. Can you just talk about what that was?
Yeah, others have that you've talked to earlier today have slightly more elaborate, works that they've created, scripts they've created.
I like the yeah. You're talking about the acts of the play. I like the acts of the play.
That's right, the acts of the play. Which much respect for Andy. Everyone should read the acts of the play. I'm more of a like fits in one tweet kind of guy. So basically
Nice.
what has to happen in terms of the ordering, and the ordering matters. I wrote this back when people were like, well, I should buy bonds because eventually there'll be a recession. And I'm like, no, that's not how it works. You have to think about the ordering. And the ordering is that interest rates have to rise, and then asset prices fall, and then spending slows, and then earnings deteriorate, and then hiring deteriorates, and then spending slows, and we get that negative self-reinforcing dynamic. And that once there's enough slowing of nominal spending growth relative to the productive capacity of the economy, that will start to create a slowing of inflationary pressures, both because wages will come down, and the overall nominal demand will also come down with it, leading to price pressures that are softening. And so far we're just not there. Like if you look at what's going on with nominal GDP growth, if you look at end demand, which is different from GDP. GDP's, whether there's inventories or not, and whether there's foreign demand or not, it's not that important. Like if you're trying to understand sort of the durability of the economy, you want to look at, final sales of domestic producers, or you want to look at, end demand, nominal demand, domestic demand. And if you look at those, basically we've been in this 5 or 6% nominal demand range for a while. Right. And it's no surprise that is happening at a time when wages and salary growth from the PCE report are also showing 6%. So we've got essentially 6% growth in wages and salaries, 6% growth in spending, roughly stable savings rate, and a nominal GDP growth at the aggregate economy level of about 6%. Okay. Well, there you go. Like it all ties out very nicely. And that will persist until there's a good reason for people to stop spending.